So yesterday afternoon, news broke that the Eurozone ministers had finally reached an agreement on the Greek bailout. Now, this equates to about 4 a.m. in the morning in Europe, and as one of the ministers put it, marathon is a Greek word, and that really does sum up these negotiations. So what's been agreed is 130 billion euros to go towards Greece. Now, all of this is essentially going towards various refinancing packages, so not a cent actually goes to the Greek government to fund its spending. Part of the agreement also ties in the private sector, so the face value of the bonds is going to be cut by 53.5%. The original agreement was about 50%. When you take into account what the restructure actually means for people's cash flows, it's actually about a 70% loss effective for those bondholders. Now, what this has done is it has at least taken away a lot of the risks of contagion in the short term. One of the key things people were focusing on was in March 20, Greece has quite a large bond maturity that they have to pay off. So we've seen some of the risk get taken away. We've seen bonds for some of the other troubled countries, their bond yields falling back as the risk of contagion has been priced out a little bit. For the euro, it was up a little bit on the announcement, but if the buy the rumour, sell the fact, it did start to fall back down. So the euro actually ended up not too much different over the course of the day. For our own currency, it wobbled slightly. It was down a fraction, around about 83.5, and that's really more to do with some news out of Australia. Now, the agreement that has just come through is designed over time to get Greece's debts down from about 160% of GDP currently to a little over 120% of GDP by 2020. So that's quite a daunting task. Now, in the past, when we've seen Greece promise to take action, it hasn't always followed through and the results have been underwhelming. And one case in point is the economy, where instead of actually growing, as a lot of the assumptions in the past have assumed it will do, it's kept shrinking, which is also one of the dangers of austerity coming through. So there's still a lot of doubt as to whether the actual agreement is all that's necessary and whether it is actually going to need to have more negotiations done in the future. And that's where some of the doubts will lie, particularly when you have the economy in Greece shrinking. Now, in the past, when we've seen these agreements come through, what we've seen is that within about a month after the agreements, the euro is usually lower than what it was at the time the agreement's made. So there tends to be a little bit of an underwhelming nature come through as people start to realise that perhaps what's been agreed to isn't all that's necessary. So we're probably not quite finished yet with Greek restructurings, and there's probably still going to be a few hurdles they need to overcome over time.